Good morning. How's everyone today? Awesome. Good to see everyone. Good to see a full house. And let me introduce Deepak Kumara Gowda. So Deepak has been investing in India across the private equity spectrum for over a decade. So his focus areas are healthcare, technology, edtech, and is currently associated with a lot of young and rapid growing portfolio companies in these sectors. He works closely with the entrepreneurs at a strategic and operating level and helps the company transition to the next level. So he serves on many boards, including iNurture, Nari, Robosoft Group, and Scanray. Earlier in his career, Deepak worked over a decade in the US across various operating roles, product management, business development, consulting, and software in the healthcare and technology sectors as well. In his last position as lead product manager at Biogistics in Atlanta, he led cross-departmental teams, partook in re-engineering product enhancement efforts, and consulted with 30 major healthcare institutions. Deepak has an MBA from Cornell University's Johnson School of Management and is an MS in Computer Science from the University of South Alabama, and a BE in Electronics and Communication from the University of Mysore. Welcome, Deepak. We look forward to what you have to say.
Thanks for making it here. And I know it's a rainy day, but the weather seems great here. And it started on time. In Bangalore, it would have been probably half an hour late. So just as an introduction before the slides come up, Ascent Capital is essentially a early growth fund. We invest in Series B companies. So we have a bird's eye view of the probably the early seed, Series A kind of a landscape, as well as the later stage, because ultimately we see deal flow from the early stage and then we exit to the later stage guys. So probably one of the few funds which is right in the middle of the ecosystem where we see both ends of the spectrum. So I think that is something that gives us a little bit of a understanding of where the funding environment is, what kind of companies are getting funded, whether the environment is going to improve and things like that. And also, given that we are raising a new fund, and I've been on the road raising a fund, I know the questions that our investors are asking, what are some of the things that they're looking at, whether they're opening their wallets, whether they how do they see India. I think those are some of the aspects that are probably that would be useful for the audience here, I think. So essentially, I mean, what I'll do is I've structured the presentation into two parts. One is why are investors looking at India, which I think all of you might have seen already, but I've been hearing this since 2008, since I moved back to India. But looks like at least some of the wheels are moving. I mean, India always moves at its own pace. I mean, I think it is Despite the Gods. I think there is a book called Despite the Gods on India, and that's what it is. But looks like things are moving right now, and that is a positive thing. But I mean, we've been telling the same story for the past 15, 20 years now. But last couple of years, or maybe in the last 4 or 5 years, exits have started to happen. Investors have started to see some money going back. And that is a positive thing. Given some of the initiatives like digitization and formalization and others, I think there is good scope. So I'll just go through that very quickly and then take you through the early stage landscape. Again, I have to say that most of the data for 2023 is not still available. So I'll base it on for this 2022, but I mean, we can probably extrapolate the 2023 data from that as well. So the macroeconomic environment, right? So essentially, India is on track to become the third largest economy. That I don't think any investors have any dispute on that. And that is something that is probably people are looking at it and saying that maybe we, just like what China was 15, 20 years ago, maybe India can ride the same wave. But I mean, obviously, the sectors are going to be different. The investment themes are going to be different. But this, from a 3.5 trillion to 5 trillion, it's a matter of time. Whether some of them say it's 5 years, some of them say it's 7 years. But it's happening, and the positive momentum is there. Working age population is 60 to 70%, as you know. I mean, I usually go to countries while traveling, and the first thing I look at is whether kids are around. Most of the countries in Europe and most of the countries in like Korea, Japan, and other places, there are no kids. Essentially, people don't want to get married. They don't want to have kids. But in India, that, although maybe the metros, there is some sort of a resistance to getting married by the younger generation and having kids, but there is a tier 2 and tier 3 that will support the population growth anyway. So I think the working age population is about 60 to 70%, and it's going, rather than declining in what's happening around the world, in India, it continues to improve. The most important aspect for us, I think, is this GDP per capita. Although the GDP might look large, I think GDP per capita is what determines whether investors actually make money, right? So people have to have the spending capacity, they have to have the discretionary income to basically look at the services that we can offer from a domestic consumption standpoint. But again, we expect the GDP to increase from $2,500 currently to about $5,000 in the next 6 to 7 years. Which is again something that we can build for India. And hopefully the market is going to be large enough to support large companies. And some of the key enablers of growth, like I said, services, exports. I think this is probably one of the most important themes for us rather than domestic consumption. India, we need to build in India for the world, and that's happening lately. And essentially what is also happening is that the quality of services, whether it is products, whether it is technology, you will see that there is no, whenever I came back in 2008, there used to be a lot of difference between what the US products look like versus what the Indian products look like. But here, now I think the gap has narrowed, and in some cases, probably we are better than the US and the European, the developed nations in terms of product design, in terms of UI, UX, and all of that, which was probably not the case. Digitization, everybody knows, even the coconut seller on the road uses a QR code to basically take payments. Again, this is, I was discussing this with one of our foreign investors, and one of the barriers for Europe and US is privacy concerns. We have all given up on privacy, so essentially that has resulted in this. So it's, whether it's good or bad, I don't know, but it is what it is, right? So essentially, whether you be very private and then not share any information and then the ecosystem doesn't develop, or in India, I think there is, I think probably if I Google my name, maybe I'll get my Aadhaar card and PAN card as well. So that is the flip side of it. Entrepreneurship, again, essentially whenever, again, I go back to my experience, whenever we got out of school or college, entrepreneurship was not something as a career you pursued. But now I see youngsters taking that as one of the major careers for them. And entrepreneurship and PhD were probably some things where you didn't get a job, so you got into a PhD or you got into entrepreneurship. But that's not the case now. So especially for youngsters, and that is because I think social nets have been built in India. Parents can afford to basically manage their kids or maintain their kids for the 2 to 3 years or 4 years or whatever, and there is not like probably inclination that you have to support your family. So that was the case about 15 years ago. But now the biggest difference for me personally is that people can do what they like. And if you look at the developed economies, the reason why they thrive is because people do what they like. In India, you get out of school, you're choosing between medicine and engineering, and it doesn't matter whether you get medicine or engineering. It is not based on your like. It just go to that field and you like it after you go in, right? So, but that has changed now. People have, kids have the option to do what they like, and hopefully they will excel in that because they like what they're doing. Infrastructure, this is debatable, but obviously compared to what it was 15, 20 years ago, it has improved a lot, especially the roads, the airports, the ports. Airports, I think now our airports, probably if you have been to Terminal 2 in Bangalore, I think that looks much better than any of the Western airports, definitely. We have probably leapfrogged some of this, and in the next 15, 20 years, I think we'll probably be much, much better than any of these developed countries as well. Urbanization is happening. Whether it is positive or negative, time will tell. But a lot of migration, which obviously the south is probably more like a developed country in my opinion, while the north is still developing. So there is a lot of migration coming from the north to the south, and which is positive because people are getting jobs and they're able to support their families back home, which probably will lead to narrowing down of the discrepancy between north and south, and also the tax collections that are going to north probably also helping. Renewable energy transition, I think this is something that is very important from, India is blessed with a lot of solar power and wind power, and other green energy things. So what that transition is slowly happening, and that is also visible in the numbers. So again, the young population, I mean, we have done a study between India, China, and the US. Essentially, as you see, India's working age population continues to be increasing, while it declines in China. US, I mean, I think US is a different animal, because as long as people want to migrate to the US, which is probably, if you ask 10 kids out of them, probably it was to be 8 before, now it's probably 5 who want to move to the US. So I think that will continue. If they fix their immigration policies, working age population will increase. Urbanization, again, we are still about 46%. We expect it to continue to grow, because, I mean, obviously there is a lot of, I mean, if you go to villages now, the only people that are left are probably the elders. And during a festival, you'll see like all the cabs coming in to basically attend a function or whatever may be the case. So that is happening, evident anecdotally, but I think data also shows the same thing. But again, China and US has already urbanized. So for us to get to, I mean, we'll never get to that kind of urbanization, because people also like to live closer to their homes, and they have a little bit affinity towards the land. But I think that's a positive trend. Physical infrastructure, like I said, road construction has improved, logistics turnaround time has improved, peak energy deficit, which was a huge, I mean, whenever 15, 20 years ago, power cuts used to be the norm, but nowadays I think power cuts are more the norm in the Western markets than in India, so that is something that is probably good as well. Although we need to continue to improve and make sure that we have adequate power to support all the manufacturing and global industries that we are trying to attract to India. Internet penetration, digital infrastructure, I don't need to talk too much about it. Like I said, it is all available, and it is probably more digitized than some of the not some of the all of the Western markets, and probably as close to some of the Southeast Asian markets. The last big thing is emergence of the middle class. I mean, this slide we've been showing for a long, long time, but it's really happening now. One of the biggest, I think if you ask any early stage entrepreneur who raised money, and also early stage VCs who put money into some of these businesses, which are mostly domestic focused, the biggest thing that they say is that we overestimated the target market, right? So essentially we are about in India, about 20 to 30 million, or probably maybe 10 to 20 or 20 to 30, depending on who you ask, are people who can probably provide, who have some discretionary income to spend. But obviously, given the large population size that we have, we thought that that was the addressable market, but that is still a long way to go. So the GDP per capita here is more important than the population itself, and that is something hopefully will get fixed as time goes on, and that bodes well for companies that are targeting the domestic market. And some of these trends are not just fads. I mean, they're essentially structural changes that are coming in. There are, I mean, independent consumption patterns where nuclear families are more prevalent than anything else, because I mean, as people move from a joint family system to a nuclear family system, they tend to spend more. Women participation in the workforce, still work in progress, but I think we should be able to at least get the education. I mean, education is fixed now. I think we need to make sure that the social norms and the support structures are built for women to participate in the workforce. Financialization of savings, as you know, I mean, I think you are all public market players probably, so you'll know that most of the run-up in the markets right now is supported by retail investors and domestic investors, and that was not the case even 15, 20 years ago. The foreign investors pulled out even a little bit of capital, the markets would collapse, but that has not happened. The other one, the last but one is factory of the world. China plus one is real. Whether India will take advantage of it or whether it's Vietnam, Mexico, or some other country, we don't know yet. But there is definitely going to be some positive momentum towards India as well, because ultimately everybody has to, whether the cost is not an issue here, the consistency of supply chains is, and that is something that probably will, despite us trying our best to make sure that industries don't come, they will come, I think. So. And quality of public transport at scale, again, this is something that is probably getting built. I mean, I know the Chennai metro is doing really well. The Bangalore metro has taken a long time to complete, but hopefully it will complete one day, and that will bring some decongestion to the cities. And that is, I mean, again, in India, everything is slow, but there are things that have been put in place that are working, and hopefully with some of the push that is coming in, we should be able to move a little bit faster. The other one is, I mean, obviously the geopolitical issues, inflation, currency. These are some of the key issues that, I mean, everybody seems to, I mean, whenever we were studying before Alan Greenspan, I don't think anybody knew who the Federal Reserve Chairman is. Now, even if you ask a 10th grade student, I think he will be able to name the US Federal Reserve Chief. That is how much Federal Reserve has come into our lives, although whether it is real or not, I still have my own doubts. But anyway, international affairs, India has been non-aligned for a long time, and that is something that we have been able to at least start to act in our own interest rather than the interests of others, and that has probably helped us with the Russian oil coming in. I was reading that Venezuelan oil is coming in as well. So as long as we appear to be neutral and try to not get into other people's conflicts, I think we are seen as somebody who can be stable, who can basically be a reliable partner. Inflation, I mean, we have always been, US has never been used to inflation, but we have always been used to inflation, and we don't have hyperinflation ever in our history, which basically is a norm in the South American countries, which is again something that the foreign investors definitely look at, because ultimately inflation is the biggest killer of any return. And currency depreciation, I mean, we've done a study, I think it's about, although it has, over the last 10 years, it has depreciated by 4% plus. Over a 30-year period, it is about 3% on an annual basis. So what investors are underwriting is about 3.5% every year. So they take that and they put the hurdle rate accordingly in dollars. So that, as long as that stays steady and doesn't be not very, if it is not too volatile, we should be okay with that. And I mean, again, everything is relative in the world. So relatively, we are better off than most of the peers and most of the investment destinations that are around the world, both in terms of inflation, in terms of rupee, in terms of leverage, and in terms of real GDP growth. Obviously, we claim to be one of the fastest, or at least we will be one of the fastest growing large economies in the world, or the fastest growing large economy in the world compared to the other countries. So this is the last one. So this is the nominal GDP that has been forecast, World Economic Outlook. So essentially, very hard to ignore the market. So the long and short of this long-winded slides was that India's time has come, and people are recognizing that as well. And I mean, obviously, whether we can get kind of inflows that China got, debatable, but there is definitely things that are on the radar of investors. India, I mean, again, from anecdotal evidence, given that I've been meeting some of these foreign investors, essentially, India was never, India was considered in, along with Indonesia, maybe not even Korea, Indonesia, Vietnam, and others before, but now at least it is not, given that there are dearth of investment opportunities available around the world, at least India is coming into the conversation. Please, let's not get too excited about it, because it's only coming into the conversation now. It is not as if people are running and waiting to put money here. So they will take their own time and they will understand what the implications are, and then take a call. But again, it's a positive. We are moving towards it positively, but again, ways to go. So now, with the good news out of the way, let's get to some of the challenges that we are facing in terms of the current environment. So the current environment in early stage investing is definitely challenging. Not just in early stage investing. Generally, if you look at private markets, it's really looking I mean, at least until 3-4 months ago, it was completely shut for, from late 2022 to about maybe June, July of 2023. There were not too many deals happening. So all of a sudden, a lot of lawyers coming and meeting us, a lot of investment bankers coming and meeting us because they did not have much work to do. But otherwise, if you look at what was in 2021 and 2022, lawyers actually, I mean, they just said that this is our fees. If you want to take it, you take it. If you don't want to take it, we'll move on to somebody else. That was the kind of work that they got, and they hired a lot of people as well. Typically, the service providers are a good indication of the deals that are happening, accountants and lawyers. So I think that was the case about 1.5, 2 years ago. For the past year, they've been idle, but again, these visits have started to come down a little bit, which means that there is some sort of uptick in the market as well. But I'll give you some data. This is mostly from the Bain report, I have to tell you. If somebody has read it, you'll see some of the data here. But I just wanted to put it in context, and they have very nice graphs, so I've just used those. So essentially, I mean, there has been a definite degrowth in the early stage funding from $38 billion to about $26 billion in India, which is a general trend across. But again, the slowdown is very, very marked from second half of 2022. So the first half was good, 2022, but the second half, I think there was definitely a collapse of funding, and that has definitely continued to this year as well. And but one of the other important things, like I said, India's share in Asia Pacific investments has now gone to about 20%. Which used to be always below 20%. We expect that to continue to grow because, I mean, it is seen as one of the better investment destinations, at least lately. And globally, we have been about 5%, and that will continue to be the case. But again, from a longer term, we always look at it in the last year, last 2 years. But private equity, venture capital is a long-term asset class. You have to look at it from a 10-year perspective, and fund terms are also about 10 years, and exits take time, investments take time. So essentially, if you look at this, there has been a 10x rise in annual funding over the last decade. And I mean, we used to get $10-12 billion as the norm, but as you see, I mean, the last 2 years, obviously, 21, 22 were quite, I mean, in my opinion, an aberration, and that is something that is returning back to the normal. And we all thought that, I mean, if you're thinking that it's going to go back to the euphoria of 21, 22, it might be a little bit difficult. So we also have to make up our mental models saying that, okay, over a 10-year period, it still looks not too bad. But one of the things that has happened is obviously in the US, I mean, India typically lags by the US. If you look at whether the dot-com bust or 2008 global financial crisis, or again, this cycle as well. India usually lags US by about 12 to 18 months. I still remember during the global financial crisis, we used to say that we are decoupled from the world, there is nothing happening to India, and then finally, 18 months down the line, it came and hit us at that point in time. But that is the case, that has been the case here. But in terms of early stage activity, we have still not seen too much going down. And that is because essentially there are a lot of companies that are getting, I mean, there are a lot of funds which have been raised. I mean, I think at some point in time we were seeing in the news more VC funds being raised than startups getting announced. So that was the kind of rush that was there to offer VC funds. There are, I think, about 1,000 AIFs in India right now, and that is a very, very large number for India. The trend that has also happened is that some of the later stage VCs and some of the larger hedge funds also wanting to get into the early stages because, I mean, they have figured out that if they can get in early at a reasonable price and on a $2 billion fund, $2 to $3 million doesn't matter. So they will just put money in, and if it goes up, they'll basically double down on it. Otherwise, it's okay. They'll write it off and move on. So that has also helped in the early stages, I think. And the most important part is essentially the pedigree of the entrepreneurs and the founders has increased tremendously over the last 5 years. And this is because, I mean, India has matured as an ecosystem. There are founders who have found companies multiple times, either successfully or unsuccessfully, but they know how to build a business now. And they build, and they've been able to also, I mean, more importantly, they may also have the networks and the proper presentation skills to make sure that that idea gets through to the investors. So I think that is something that has improved tremendously in India. And that is, I mean, marketing your idea is something that is very, very essential for you to raise capital, right? So essentially, in early stage, what are you betting on? You're betting on the founder's vision and you're betting on the market. And if you're able to articulate clearly why you should be funded, I think those kind of companies get funded. And that was not the case 5-7 years ago when founders were still floundering to better market their presentations. Presentations used to look terrible. Now, if you look at it, even somebody who's just starting up has a presentation of the quality that is tremendous. There is some India-specific innovation as well. I mean, obviously, every 3 to 6 months, we hear some of the themes coming up. There is climate tech, there is agri-tech, there is deep tech, EV, IoT, and all of those. So essentially, a lot of companies are now solving India-specific problems. India-specific problems, see, India, if you look at the West, most of the companies that are coming out are from a discretionary standpoint. In India, we have to still fix agriculture, we have to still fix education, we have to still fix basic stuff, right? So I think there are tremendous opportunities to just fix the basic stuff. And the idea is not to be, I mean, it's not like you have to, I mean, we are sending rockets with private companies as well, but the idea is not to be a rocket scientist, but if you can execute well, and there are enough problems to fix if you execute well and build large businesses. And trickle down from the public market route, not much in the early stage, at least until last year. So that is something that I think has started to a little bit affect us. But if you look at the broader indices, they've done reasonably okay. They've held up, and that has given confidence to some of the investors to basically also take some bets on this. Growth funding obviously has reduced tremendously. Like I said, I mean, I think the rounds used to happen in 3 months, and the follow-on rounds used to happen in 1 or 2 months, and you would mark up your portfolio 4 or 5x. That was a kind of momentum that was there in 21 and 22. But again, what has happened is a lot of these funds, like a Tiger, Process, even Peak 15 or Sequoia, a lot of these funds who are the ones who are leading these growth rounds and taking quick calls, they have all but stopped or disappeared. We hope they come back, but we don't know. And that has caused a dearth in growth funding. Also, it's much easier to raise a 20 to 30, 40 million fund than to raise a 250, 300 million fund. So that is something that definitely in the growth stage you'll need at least at least 150 to 300 million dollars of corpus for you to really take a lead in growth stage. That is something that has not happened over the last. I mean, people with money obviously are looking at it but not deploying because there is no hurry. And also pricing has become difficult, right? So essentially, I mean, there is always a saying that you cannot get fired for buying IBM stock, right? So in this case, you don't want to price around and then it goes down 50% more in the next 2 months. And that is something that is very, very difficult for any fund to justify and to their investors. So what they're doing is they're just saying that let the market calm down and then we'll take a call rather than put our neck out there and put a value to it. Unicorns, I mean, I think the term unicorn was coined because these are mythical creatures, but they became very, very common. And that is something that, I mean, we never used to hear of billion-dollar companies in India, but now there are 108 or whatever of them, or maybe now it's 50, I don't know. Yeah, so now I think the minting of unicorns is becoming slower, which is probably good in terms of valuations. Hopefully the financial metrics justify the valuations of $1 billion. But again, I have a personal opinion here. I don't know, I mean, for a $3 trillion economy, how many $1 billion, $10 billion, $100 billion companies we can build. Because ultimately, venture investors depend on those kind of outcomes for them to give returns. So that is something that we have to think about. But anyway, I'll cover that in a little bit later. But again, unicorns, some of them obviously have reached that stratosphere, and they have a lot of capital. So they're holding on to those valuations because they're not done any rounds after that. But a lot of them are now coming, and what we are seeing in the market is a lot of convertible structures are coming to the market, saying that it's at a 20% discount or a 30% discount on the next round, hoping that the next round will correct itself. But at some point in time, some of these companies will have to bite the bullet and take a lower valuation, just like PharmEasy did. Performance blues, obviously, like I said before, the addressable market and the kind of growth rates that they expected has not panned out, both the founders as well as the investors, and that is something that is definitely hurting but the ecosystem itself, not just the investors. So there have been a lot of layoffs. I think everybody thought that COVID was the new normal, and they hired, and even in the US, large companies like Meta, Google, Facebook, even Microsoft, they all laid off people because, everybody, even the best in business, thought that COVID was the new normal, right? So I think we cannot blame our entrepreneurs for that. But again, in India, this is a rare phenomenon where layoffs, but the good comes with the bad. So if you're looking to build high valuation companies, you have to hire, you have to basically lay off. It is more a capitalistic mindset than a socialistic mindset that we typically hang on to. Distress M&A, I know that whenever COVID hit, there was a conference by one of the investment bankers where they did a matchmaking between two companies that were struggling and hopefully getting back by, so if there was a 1 + 1 is equal to 3 or 4 is what the theory was. That is again happening. There is going to be a lot of these M&As that are going to be happening because a lot of these companies as a standalone business might not be able to raise capital, and it might also look you have to look at it from a venture perspective that if I get shares in a company that is performing okay, then at least I can kick the can down the road a little bit rather than write it off. So that is something that definitely will be driven by both. I don't know whether it's going to be driven so much by the founders, but it's definitely going to be driven by the investors. Corporate governance, I think this is the biggest challenge we always face in India. Before it used to be infrastructure companies that had corporate governance challenges. We always thought that tech was immune because of this, at least the aura that was created by Infosys and Wipro and those likes, which held corporate governance at a very, very high pedestal. But with the kind of diligence efforts that have happened over the last 2 to 3 years, it is corporate governance issues have come to the fore, including India's biggest unicorn. A couple of companies have gone bust because of corporate governance. People have sued founders. And that, I think, is the biggest challenge because, see, for somebody sitting outside in the US or in Europe and others, they are okay to take a business risk and lose because of that, but they're not okay to take a corporate governance risk because that essentially means that their diligence processes are not right? So that is something that is going to be affecting the entire ecosystem, and this has happened. See, ultimately, I don't blame the VC funds or us. Very difficult to, if a founder decides to do something, you're not there in day-to-day activities, you're only monitoring it on a periodic basis. If you have 50 companies in a portfolio, which a typical VC fund will have, you cannot be chasing each and every one of them. The teams are not big enough to do that. But again, hopefully the ecosystem understands that corporate governance is probably the #1 issue. If there is a business failure, people still accept it, but corporate governance failures is very difficult to accept. And why have investments slowed? Because exit momentum has slowed, right? So essentially, if you look at it, if investors continue to get capital back, they're willing to take risks on investments. But if the pipeline inflow dries up, then the outflow also dries up. So essentially, if you look at it, the first half of this year, I don't think there were any IPOs happening. Even in the second half, if you look at it, most of them are like EMS companies and actually old economy companies that are getting funded. And some of them obviously have they're not the poster boys of startup ecosystem, let me put it that way. So the last one that has happened, which is Mama, that happened yesterday, 7x subscription, but if you hear the chatter in social media, I think there is a lot of negativity around it. Hopefully it will, they will be able to demonstrate performance to get it done. But from a larger ecosystem perspective, it is very, very important that some of these companies are able to list, and there is a good public appetite for it. Otherwise, very difficult. And also, I think what has also happened is whenever we used to do our exit analysis about 4 or 5 years ago, we always gave first preference to strategic, second preference to secondary sales, and the last preference to IPOs. The reason is not because of value or anything like that, because the reason is because IPO windows are very short. They cannot, I mean, we cannot predict whether the IPO window is open whenever the company is ready, right? So it has to be a perfect match of the company being ready, the market being open, and there being investor interest. So that typically happens in India every 5 years or so. That is not something that we can bet on as a fund for an exit. But now I think every entrepreneur you ask, they want to do an IPO because of the last 2 years. And that I think is something that mindset will have to change, because there are only so many companies that can go for an IPO. So there might be some pushback from the friction between the investors and the entrepreneurs because of that. And as you know, I mean, I think even in the US, a lot of these companies have deferred their IPO plans, and whoever has gone as well, even the shop Clavio, which was supposed to, I mean, a very good company, going at a reasonable valuation in terms of multiple on ARR, but that has also corrected, I think, after listed players listing the last time I saw. Yeah, I mean, I think that the tepid for performance, I mean, see, ultimately the game is that if investors and public make money, that is when the investments will continue. But as you know, there has been a little bit of a, not a little bit, I mean, there has been a severe correction in some of these companies that have listed. They listed during the euphoria, and now the reality has sunk in. But I mean, again, work in progress. I think they will hopefully build into the valuations, and then public makes money, and investors make money as well. And the last one is that, I mean, new listings have stalled. I mean, if you ask anybody in the late stage growth investment ecosystem, they will say that our company is going for an IPO in FY25 kind of a time frame. If all of them list, I think probably about 50 companies should list at that point in time, and probably at least 60 to 70 billion dollars, and maybe more of market cap should come into the Indian market. But again, that is wishful thinking. Not 50 companies will be able to list in the next FY25, because ultimately everybody is expecting, I mean, at least a lot of them think that the market is going to come back. This is an aberration. This current environment is an aberration, but maybe the truth might be that the aberration was 21-22. So looking ahead, I think basically if you look at it, this is where the context is today. And I think I have some latest numbers as well. So in 23, only 1/4 of the total funding that has happened in 24. So essentially if you look at this, so 1/4 of the funding has happened in the 9 months. So I think you might expect about maybe $12.5 to $13 billion coming in this year. There has been a 45% drop in deal value this year in 23, and M&A values are down 48%, right? So, and ticket sizes are also down about 25%. So essentially, I mean, the market is still correcting, and I think little bits green shoots are available in the current quarter, but again, whether they will sustain depends on how whether US enters a recession or whether India. I mean, again, we'll have to see that. So looking ahead, I mean, there has been a lot of dry powder, which is essentially capital that is committed but not invested, is called dry powder in our parlance, and that a lot of funds have raised capital, and there is enough and more investment. But again, the willingness to go out on a limb and make investments is still not there. I mean, some of the names that we talked about, everybody has raised funds that are larger than the previous funds. They also have, we also have new entrants coming in. The good thing is this, but the opposite side is that there are a lot of the tigers and the processes and others, hedge funds, which used to take quick decisions, and those are not there. But again, Singapore probably is more active. Singapore government is active. The Middle East is getting active in India. So I think, and Canada, I don't know what's going to happen, because Canadian investors were a large part of our investments as well, and they're natural allies as well. Again, with the political skirmish that is going on, whether they'll come back, whether they'll up the thing, we don't know. Japan, still not much, but I think there is some interest in Japan and Korea as well for India funds. The larger trend for me is the new investors that are coming to the party. Essentially, now early stage investing, especially seed, is seen as something that is vital to the portfolio. Obviously, I think it's all a cycle. So people read the headlines, they think that people are making 100x or 50x or whatever may be the case, and they try to get in. Again, this has definitely started to increase, and we'll have to see whether this trend continues. But there are about 80 plus active micro VC funds which have raised about less than 50 million of capital. They have raised 5 plus 20 plus million funds this year itself, or 22. And there are a lot of thematics coming in, right? So deep tech is a big theme. Actually, I had an inquiry from one of our investors yesterday whether an AI only fund makes sense for India. So there are a lot of climate tech funds are there. So there are a lot of these thematic funds that are coming in, which are very, very specialized, and also entrepreneurs who come out of had an exit in the last couple of years, or some of the serial entrepreneurs. They are also trying to raise capital and become VCs, because grass is always greener on the other side. So we always wish that we are entrepreneurs, and entrepreneurs wish we are VCs. This is what I was saying, that so if you look at it, the deal momentum from entrepreneurial, some of the marquee entrepreneurs in India, that has not decreased. And I used to hear that some of these, you send a WhatsApp and you get 25 lakh check, something like that was happening in the last 2 years. So I don't know whether it's continuing to happen, but overall for the ecosystem, it is good that entrepreneurs who have made some capital are seeing this as an asset class and trying to support some of the early stage companies. Startups are also coming to their own, like I said, because of good management teams, and hopefully some ecosystem has been built where you can go to mentors, we can talk to some of these people on what are some of the perils of building a company, what are some of the things to look at. So essentially, 30% go, like I said, from a growth round perspective, they go on to raise subsequent rounds. So essentially, this is something that is important because ultimately you'll have to have sustainable companies coming in. But the good news is that the startups are definitely, the quality of the startups are definitely improving. And the entrepreneurs are able to access both, at least they're able to get meetings with investors, and also have mentors in their circle who have done this before, and they're more than willing to spend time. So that is something that, I don't know whether it's an equivalent of a Silicon Valley, that is still time to go, but a small, loose confluence of ecosystem participants is definitely happening. Exit mechanisms, like I said, they are becoming available. Promoter buybacks always used to have a negative connotation, but now I think there are a lot of financing options available for promoters as well, and they will be able to, if there is, the company is good and the investor is looking for an exit, that has come in as a viable option, although still last in the list of options for investors. Secondary sales, a lot of these larger funds that have raised capital, they have raised capital for Asia, and they're sitting on a lot of this dry powder, and they have to invest because ultimately if they don't invest and delay the funds, the next fundraising gets delayed as well. So it's essentially in their own best interest to start looking at some of these deals, so that if you have seen it, you might have read a lot of deals happening in the hospital sector now. And anything that is $200 million and upwards, there are a lot of funds that are looking at bidding. and trying to take a majority stake. IPO public markets, like I said, I think if you have a reasonable growth story, and I mean, at least now there is more awareness of the IPO market. Even the service providers are quite good. Bankers have been able to take multiple companies IPO. So the current generation of people who are working in these merchant banks as well as service providers, whether accounting or financial or legal, they got exposed to the IPO markets, and that is something that I mean, whenever the window opens, that is good. Merger and acquisitions, I think a lot of these global companies are definitely looking at some of these Indian companies. I mean, we actually sold one technology company based out of a tier 3 town in Karnataka to a Japanese conglomerate. So we were able to do that, and that kind of interest, I mean, obviously some of the Indian companies also bid for it, but this was probably about 25-30% higher than whatever the Indian company's bid was. So I think there is reasonable amount of interest for mergers and acquisitions. We have a couple of companies that we have launched the process as well. So we'll be, I mean, 6 months to 8 months, I should be able to tell you whether that interest continues. I think the other biggest positive for India, like I said, despite us doing nothing, because China is now untouchable from an investment standpoint, especially for the US and Western markets, people are starting to look at India. But we were very, very gung-ho about 6-12 months ago, thinking that a lot of money that was allocated to China, because the allocation to China is huge, will come to India. But I don't think that's the case. We'll get our fair allocation, but a lot of money is also moving into other countries. I mean, Japan has become a hotbed of investment now, for example, and I think a lot of the China money has actually moved to Japan. And I mean, but we also feel that from a longer term perspective, it will come, definitely some portion of it will come to India. And I don't see that China is going to start attracting any large VC or investment PE inflows in the near future, because even if you look at Sequoia, the spin-off, the China was one of the best performing funds for them, but because of governmental pressure, they had to hive that off and give it to the local team. So that is the kind of pressure that regulatorily they're facing to deploy money in China, and that is going to continue to happen. And if you look at it, I mean, the China has suffered a net outflow, and that is unheard of, right? And also the listed companies, I mean, I think I was listening to Ashwath Damodaran, the Dean of Valuation, as they call him, and he was saying that on a fundamental basis, for example, Alibaba, he can value and come up with a number, but he doesn't know what is the portion of his ownership, because the Chinese government can determine his ownership is 0 or 1 or whatever he has bought, right? So essentially, it is very hard to value those companies, is what his perspective is. And obviously, he is one of the luminaries of investing in the US. So if he is taking that stance, look, I mean, you can extrapolate that the public is probably shunning some of these Chinese stocks. Now, the positive news is that some of the red flags, right? So, I mean, see, the way to look at it is there are two ways to look at it. From a fundraising perspective, there is dry powder, but why are people not investing? That's a legitimate question, right? So essentially, this is what is called an LP denominator effect. What it typically means is that as a, let's say, CalPERS has 60%, I mean, just for ease of use, 60% or 70% in US public equities, and then 40% in private markets. Essentially, what has happened is the 60% has gone down to 30-35% because the markets have corrected tremendously. But the 30% that is 30 or 40% that is the private equity pool, the markdowns have still not happened, right? So essentially now private equity has become 40 or 50% of their overall asset allocation. So they have to change that, and the only way to change it is reducing the allocation towards private equity or the public markets going up. Public markets going up is a longer term phenomenon. So what LPs have taken call is that they will pause investments, and one of the things that they've also told their performing managers as well is that given that the budgets for the year are probably already done with, you probably delay fundraising by a little bit so that you can so that we can participate. They really want to participate, but it's taking time. So until and unless this goes out, raising more money from a VCPE perspective might be difficult. The second part of the problem is also outperformance of US venture, right? So essentially, if you look at it, Treasury is yielding what, 5.5%, or 10-year is yielding now, I think, close to 5%. And Indian equities, probably private equity, venture capital might be at 12, 13% net, right? So essentially, the question that if I was a US investor, I would be asking is, with zero risk, I'm getting 5% or whatever, 5, 7% if you do corporate bonds. Why should I go to some place that I don't know, or I mean, some place where things are still getting built and get a 12, 13% yield? So that is a legitimate question, right? And also, from a venture fund perspective, although there has been a correction in the last 2 years, people have, investors have made money in US venture, and they made more money than whatever India has been able to give. And for the country risk premium that you can attribute to India, I think it doesn't justify. And the large, since we are fundraising, the biggest thing that we always face is DPI versus TVPI, right? So DPI is essentially what you have already. So you've invested 100, you return 20 rupees, and you're still, let's say, you're marked up at whatever 200 rupees, right? So DPI is essentially what you have returned back, which is 20 rupees. So initially, what used to happen is, at least not initially, about 3-4 years ago, before this euphoria, the DPI and TVPI. The TVPI estimates would be close to what the DPI will end up for the fund. But that discrepancy has increased a lot because a lot of these markups have happened, and people have not taken write-downs because based on previous round valuations, which are valid for a year, they're still holding it at the same price. So there is a huge difference between DPI and TVPI. In the current vintage funds, and investors are only asking one question: what is your DPI? So as long as you can show DPI, you're in the good books. If you're not, then they are discounting TVPI completely. And giving a DPI is very difficult in this environment because ultimately exit avenues are closed. So that is a huge challenge. The next one is reliance on retail investors. Again, there are two ways to look at it. It's a positive because a lot of these investors are participating in these funds with 10 lakhs, 25 lakhs, 30 lakhs, whatever. Some of the funds have 200 investors, and you go to a wealth manager, you pay fees, and they will raise money for you. But that is the positive side. So there is a democratization of VCP, right? But the question is, let's say things go bad. VCP, venture funds and private equity funds, the decision making is very, very, there is no method, right? So essentially it is very subjective, it is not very objective. So it is very hard to explain after the fact if things go bad. So if in a good environment, having these retail investors is good, but in an environment where the funds are not doing too well, is it going to lead to litigation? Is it going to lead to conflict between the retail investors and the fund managers is a question that we have to ponder. And given India's legal system, these cases can go on forever. And is that going to be a distraction is something that we have to figure out. Again, too many early stage funds. There are a lot of micro funds that have got raised, which is good. But again, it is also a problem that some of the companies that they fund might not be fundable and might not be able to raise the next round. So hopefully, some of the projections in the US is that more than 50% of the micro funds will disappear in the US, which have raised over the last 2 years. In India, I don't know, but I hope that these micro funds are able to raise capital and go on to the next round. And the last one is experience of down cycles. Basically, a lot of these funds are coming during the last 3-4 years, and they have not seen a down cycle, right? So the down cycle experience is very, very important for you to take a measured view on investments. And hopefully this down cycle will teach some of our fund managers as well as entrepreneurs the right way to build businesses. And it's good to have down cycles because that puts you in that gives you a perspective on the right way to invest or build businesses. And finally, election, I'll not get into it. If obviously everybody expects the current government to come back, but if it doesn't, then there will definitely be a pause for 6 to 12 months, although India, runs despite the government, in my opinion, but anyway. VC perspective, addressable market size, I already talked about. Power law is something, essentially in the US, 1 or 2 companies return the entire fund or multiples of the fund. And that will be 10 billion, 20 billion, 30 billion kind of outcomes, where they will own, they'll get diluted to whatever, 2-3%, and that usually returns the fund. But in India, whether those kind of companies can be built, Large companies can be built, question mark. So it will take time, and I think we have to rely more on smaller exits and hopefully more winners than losers. Valuation I talked about. Scarcity of late-stage investors. The main problem with late-stage investors going away is that, you have a company now that has raised Series A. If there is no Series B round available, what are you going to do, right? So essentially, in the longer term, all of these, if there is a dearth of capital in the growth rounds, then there is no exit mechanism for early-stage investors. And it becomes something like a living dead. The companies become a living dead, right? So essentially, that is something that we have to be very, very clear because early stage, even though if there is funded, if there is no growth stage and late stage investments coming, the early stage is also going to take a hit at some point in time. Corporate governance I talked about, exits I talked about as well. And some of this, I think you'll know, but in the interest of time, I'll just go through it quickly. Solving a real problem in a large enough market, not overestimating the market is something that is very, very important. And there are enough and more real problems to solve in the Indian context. Also, I think we like mostly companies that are also building for the world, and given how the world has come together, especially from a development and sales standpoint, I think that should be something that India should be good at. Businesses with strong tailwinds, there are plenty of tailwinds that are industries that are experiencing tailwinds because of various factors that needs to be considered. Entrepreneurs I already talked about. Positive unit economics, I think a lot of these companies that got funded over the last 2 years was like grow at any cost, then we'll demonstrate economics. That might not be working anymore. Now it's gone to the other extreme where you're talking unit economics from day one, which is also not very good, but we have to be somewhere in the middle. Adequately funded, if you look at it, that is some of the things. Essentially, you need to at least have runway for 18 to 24 months. Otherwise, it's going to be difficult. And strong cap table, people who can support you, and potential for an outsized outcome. Like I said, while the downside might be limited, downside is there, but the upside potential also needs to be huge. In the US, there is a saying that your downside can only be 0, but your upside can be infinite, right? But that I don't know whether holds true in India or not. Thank you.
Very interesting insights. Lot of stuff to discuss, lot of stuff to talk about. So I'll just set the stage, give you some context about me, and so that it will give a little bit more color to the discussions. So we are doing what Deepak spoke about. We are in that queue that Shamit mentioned with SEBI. We are raising 50 million. We are waiting for our SEBI approval. They are backlogged beyond belief. We are one of those hundreds of funds at the bottom of that pyramid, right? And one interesting tidbit this morning when some of our portfolios saw that we were talking to Deepak, they were like, so can we schedule a meeting? Can we get a pitch? And so that kind of goes back to the dearth of funding in that stage. I think while the bottom of the pyramid has gone so deep, I think as that pyramid goes further up, it's very narrow. So having said that basic context, we invest in some of the stuff that Deepak mentioned, and that we are very focused in early stage deep tech. We're a thematic fund in that sense of the word. So having said that, Deepak, could you talk a little bit about your own portfolio? I see some very interesting names, ACO and a few, Radiant I think was another as well. Could you talk a little bit about some of your portfolio? How are you guys thinking through strategy as you're also raising right now?
Yeah. No, so essentially, we are not a tech-only fund that has helped us. We used to look very stupid about in 21, 22 because essentially everybody was getting a markup every 3 months, and ours is a longer haul game, right? So essentially, we have a portfolio of 10 companies from the last fund. 30% is in healthcare, pharma. So 2 pharma companies we have, which have nothing to do with the current environment, and then we have, I think, 3 consumer companies, Fresh to Home,
Big Basket.
Big Basket was from the previous one. So essentially, yeah, I mean, I think consumer is about 25%, then tech is about 20%. We also have an AI company called favour, which is solving, which was before the AI, hype, so before OpenAI. So, and then we have financial services. So essentially, the way we are looking at it is we have been beaten by infrastructure in the previous fund, so we'll never touch infrastructure. But these are 4 segments that essentially drive most of the returns in venture private equity, in our opinion. And I think as long as, and we also want to give a microcosm of India's economy, the fast growing part of it, to our investors. So that, I mean, our goal is to return 3x and 25% IRR, right? So we're not trying to shoot for the moon and do a 10x fund. As long as we don't lose capital, and which is again a learning, and do a reasonable job in picking and supporting, I think we should be able to deliver that kind of returns, in our opinion.
Got it. So, see, there's a lot of activity in the early stage, right? There are so many micro VCs, angel networks, incubators, accelerators. There's a serious deepening in that segment. And to that extent, I think there is FOMO, right? There are, people investing as low as 25,000 who are calling themselves, angel investors through this, Cat 1 angel structure that is people are abusing, right? So how would you as a Series B investor, right? How would you see that? Is it better for your funnel? Are you, looking at specific places to find your deals, so to say, with this, deepening in that base?
See, essentially, if you look at it, some of the, I mean, I divided into the 4 pieces that we have, right? Healthcare and pharma, usually we are the first institutional investor, and there I think that doesn't matter. But if you look at the Series B investments that we make, every year I think about 200 companies raise Series A funding, and that is our funnel, right? So essentially, if you look at it, we are looking at doing 3 to 4 deals a year. So there are 200 companies that are there, and over a period of time, I mean, that 200 can be 300 or 400, depending on whether they've raised in the next year or so, right? So essentially, we have done a study on that. So about 200 companies every year are coming out and doing Series A, and then we have to pick 3 or 4 out of them. So deal flow has not been a challenge. And I mean, to answer your question about the ecosystem, see, ultimately, if you look at the excesses of even the .com era, there are a lot of companies that went bust, right? But again, there are a lot of companies that got built because of that.
Right.
Like a Google came out of it, Yahoo came out of it. I mean, if you look at any of the companies that are there today, they came out of that, right? So essentially in India as well, I think there is going to be a shakeout, but it is good for the ecosystem because now people are more aware of what venture capital is. They know how to access capital. They know how to, what flies in terms of investments. What is a lifestyle business, what is a venture business. So those kind of awareness has come, and more importantly, the ecosystem is getting built. Right, so yeah, so there are different pools of people that are available with different expertise, which is very, very essential for the startup system to thrive. So, like you rightly said, there are incubators, there are accelerators. We don't know whether
government money is flowing into tier 2, tier 3
absolutely.
Colleges. There's so much of money.
So I mean, I think that is the positive side of it. But the flip side of it is also, I mean, for an entrepreneur, it is confusing, right? I mean, like you rightly said, we don't know who's the investment banker and who's the investor.
Investor at all.
Because a lot of these investment bankers are posing as investors, right? So essentially, I mean, it's a good environment to be an entrepreneur. I mean, at least 6 months ago it was, but now it is going to be a little bit harder. But it is supposed to be hard. It is not supposed to be as easy as you go and raise like $2 million and raise like $10 million in the next 3 months. That's not how it works.
Right. No, and I think that's a great point in that there are all these micro VCs who are operating on both sides. The bread is buttered on both sides, and even the crust is buttered. They're collecting money from all directions and posing as an investor. One of the things you mentioned was, these later stage funds coming, earlier, right? Sequoia, Surge, or, all of these guys have like early stage programs, right? How do you think about that? One of the things that I find, kind of difficult to comprehend in that stage is that if the, later stage fund invests earlier and then they don't follow on, that becomes an albatross on the neck of the company, that entrepreneur, right? So is that not a concern for some of these guys?
See, I mean, if you look at, there are two schools of thought there, right? There is a benchmark school of thought, which is benchmark ventures in the US. They say that we are only Series B, Series A.
Yeah.
After that, we don't have any follow-on reserve, right? So there is no signaling bias there. So essentially, good, bad, ugly, we are not coming in, right? So that is one school of thought. The second school of thought is the Sequoia school of thought, which says that, okay, I'll go in early and I'll support it over a period of time. I don't know which one is right, which one is wrong, but you're absolutely right. I mean, in India's context, if an early stage fund doesn't, I mean, if a late stage fund comes in early and then doesn't support it, that is essentially like the death of that company, right?
Right.
But what they have done differently is that they have separated out the programs. So the Sequoia Atom is not, or Axel Atom and Sequoia Surge, they're not the same as Sequoia Atom, right? So that's what their claim is.
They claim,
it's a different team, it's a different mindset, right? So that, I mean, a lot of these companies have got funded by others in the last 2 years.
Right.
So we don't know whether that's going to continue going forward, but it has happened. From our own perspective, see, I mean, we don't want to get distracted with this, to be honest. We are a small team.
Right.
We raise our own capital, so we cannot lose money. So I don't think we'll get into the early stage. We are more comfortable in the what we are capable of.
Right. So you mentioned, I mean, you spoke a little bit about the India-specific innovation that was happening, right? While, you know, there is India-specific innovation that is happening, but you also mentioned, I think, earlier in the presentation about build in India for the world, right? I mean, one of the key things that I believe, and I know that kind of translates through our investments, is building in India, but there isn't enough rent to be captured in India, right? Like, I'll give you an example, computer vision, right? I have personally seen about 100, you know, startups in the computer vision space, right? But is there enough value from offering that solution to a company? Like, let's say a large Britannia or an ITC or, you know, one of the auto companies, there are 35 guys lining up to offer the same solution, computer vision based inspection, right? Which is low hanging, right? Whereas the actual value is in the West, right? The actual, you know, somebody who's willing to pay for, you know, clear innovation, right? Versus, you know, copycats, which are, you know, 100 that follow in that same segment, right? I know people who are building computer vision solutions for Britannia who are, you know, just checking the quality of the biscuit. Has it come out properly, right? And that is, in that hierarchy, that is bottom of pyramid, right? So how are you thinking about the companies that are, you know, able to capture better value out of selling in the West versus, you know, operating in India?
No, I'm biased towards building for the world, because ultimately in India, like you rightly said, we don't know what the market is, right? But again, if we believe that India is going to be a large market, I mean, foreign companies are coming in and investing in India because they believe it's a large market.
Right.
There is scope for both. But for example, I mean, in Haber, where we are automating industrial processes. Initially, we started off with paper and pulp in India, right? Now we have signed up one of the largest paper and pulp industries in the US. So the machine learning algorithms, the product was honed here, and now it is getting global use. I think that might be something that might be useful, because here it is cheaper to basically innovate and make sure that the product is all right, and then take it to the West. Similarly, I mean, a lot of these SaaS companies are doing exactly that. But again, people have to be beware that US is essentially the graveyard for some of the IT companies, product companies, right? You have to spend a lot of money. By the time you understand that the salesperson has not delivered, you would have already taken a couple of $1 million off, right? So those are some of the challenges. But I think looking at it, how technology is coming together and the kind of deep understanding we seem to be developing, I think building for the world is more important. I mean, that is the bias I have, at least.
I think that I have that same bias, because the ROI on that entrepreneur's time, right, and effort. I mean, one of our largest investments is in a company that does CV in the oil and gas risk space, right? They struggled for years with the BPCLs, HPCLs, IOCL, Reliance, right? They had the 100% of their business, but the amount of effort it took and the hoops that they had to jump through, I mean, when they started
But
focusing.
again, you have to have that kind of a differentiator. See, if you are building
you can't be
if
run
you are
off
building a
the.
run-of-the-mill, you'll still have
You'll still have
customers here.
to.
But it's a lifestyle business. It's not
It's
a
not.
venture fundable business.
Understood. So, I mean, kind of coming back to that, the topic of reduction in that growth stage funding, right? So, what is that driver? I mean, were we over ebullient at the very beginning? One of the things I keep hearing about in conversations is our estimates of the market size were much larger. We keep using the population as a metric, whereas the core people who can spend are 100 million or so, right? So, what is the driver that is, keeping that dry powder dry today, or,
See, I mean, I think one of them has to do with the company, but there is a more nuanced thing to it. See, obviously GPs has raised capital, but we are basically beholden to our LPs, right? So essentially, although the LPs have given us commitments, and if they are feeling a pinch of having to send money in for an investment, typically you don't do it. Right. So essentially what has happened is the exits that were planned have gotten pushed. So you're not given money back to your LPs.
Right.
And now you're asking them to put more money into the company. So essentially that doesn't put you in too good a light in your relationship with your LP. So that is, for us, LP relationship is paramount. So you have to be very careful on because it's all cash flow. I mean, there cannot be a mismatch in LP cash flows, right? So that is one of the reasons, primary reasons. So dry powder is there, but nobody wants to antagonize the LPs. So, and there is no hurry, right? I mean, whatever was available 3 months ago.
IRR is not hurry.
No, IRR, no, we have got only commitments, right? Actually, it is better for us.
The drawdown is not happened.
Drawdown has not happened. So whatever is available 3 months ago is also available 6 months ago at the same price. So why would you want to hurry up and do it? And the last part is, obviously pricing. Nobody is looking at what the price. See, something got like Mama got priced at 1.3 billion, whatever, 2 years ago or 18 months ago, whatever that is, right? Now it's going at the same price. Now somebody, did any pre-IPO investor come in? Nobody came in because they were not very clear.
Right.
So nobody knows what the pricing is, whether it is 7 times revenue, whether it is 2 times revenue, 4 times revenue, nobody knows.
Right. So, talking a little bit about that exit piece, right? You mentioned Mama Earth and, is there some rationality that is, you feel, sweeping into the markets? There are, I think, a bunch of questions about, the funding winter and things like that. In the private market itself, right? Swiggy was marked down multiple times, but then last I read it, it's been marked back up by, a couple of these investors. So, how do you...
See, basically, markdowns are bad for everybody, right? It's bad for the founder, it's bad for the VC fund, it's bad for our LPs as well. So it's very difficult to take. But again, you're caught between a rock and a hard place because let's segregate it into two things. There are companies that have raised a lot of capital which can withstand for the 18 to 24 months and hoping that better times will come. Then there are companies that have to raise now.
Right.
So they were saying that second half of 23 will be better, but second half has turned out to be more worse than the first half. So now they have to raise. So what they have started to do, at least we are starting to see deals where they're offering convertibles. Now for us, why would you do a convertible in this environment? You would want to do a straight equity deal, do it at a reasonable valuation, because 20-30% discount to the next round, it doesn't make any sense in this environment, right? So slowly, I think companies are also coming to a stage where they are saying that, okay, but again, if you look at it, everybody is relying on liquidation preference for them to at least get their capital back. Now, if you do a down round, what happens to the founder? The founder will be left with nothing.
Anti-dilution.
Anti-dilution will trigger. So those are some of the nuances that are preventing it. But I think...
Farm-Easy was a mess, that way.
Yeah. So there is nothing that finally they had to structure an ESOP scheme is what I read. But essentially that is the challenge in terms of taking a down round. It is not only valuation, it has much more implications than other than that.
Right. I think we'll go into some of the questions that the audience has sent in. So one of the questions is, so was the funding winter, just a scare?
No.
I think it was a reset, I would say, right? It's a part.
No, I think, I don't know whether it is winter, but it was too sunny, I think. So, I mean, see, ultimately you have to go back to the mean reversion is what all public market participants talk about, right? It's reverting to the mean. I mean, I think this might be the new normal. We are thinking it's winter and summer will come, but this might be the new normal. I mean, at least that's what I think it is.
I mean, broadly, I think there is money there for
There
good
is money.
ideas. People are funding. I
See,
don't.
it's not like there is no money. I mean, obviously because
Deals are happening.
because it was so easily available. Now it is looking like
Relative to
winter.
where it was 2 years ago. That's the right. So, how is corporate governance tested in early stage investing versus listed equities? I mean,
See, I mean, again, it depends on whether you run a concentrated portfolio or whether you run a indexing strategy, right? Most of the early stage, seed stage companies, teams will be less than 10 because the fees doesn't support it. If you have a 50 million fund or 20 million fund, maybe you'll get 2% as fees. So that will not support a very, very large team, right? And at seed and if you're putting $50,000 or $100,000 or $500,000, you cannot hire KPMG or the Big Four or the best lawyers in town to.
even if you hire them, I mean,
Half the money will go there.
will go there. And I mean, even with them on board, we have seen so many things blow up.
It is there, but at least there is some. I mean, they've done it, right? So it's. I think it's a problem. I mean, I think it's a problem with the identification of the founder. If the founder
100%.
and the management team decide to do it, I don't think you can stop them from doing it, and it's very hard. I mean, for example, Go Mechanic, if they had parts in some like Chhattisgarh somewhere, you think Sequoia would have gone and checked Chhattisgarh? No, they will not be able to. So I think but entrepreneurs need to understand that it hurts the entire ecosystem. They're not just hurting themselves and the company, but it's hurting future entrepreneurs as well. This has happened with infrastructure before, right? No, but now nobody wants to touch infrastructure because these excesses have happened. So, I mean, if the same thing happens to, for example, education, EdTech, right? EdTech, there used to be Edicomp, now there is Byju's. Now, I mean, there are 10 different companies that are going through different stages of whatever is happening. Who will touch education if these are the things that are happening, right? I mean, that is a challenge for the entire. So, as an education entrepreneur, I didn't do anything wrong. I am running a good business, but I'll not be able to raise any capital. Is it fair?
And I think that's a great point because I was talking to a banker yesterday and he was saying what Vasan Eye Care did to that ecosystem. Agarwal was not able to raise for the next 3 years just because of them. And even a large fund for that example, you spoke about Sequoia China having to divest from because of regulatory. But I think Sequoia India had their own share of like governance issues. 3-4 companies were in that segment. Where, according to you, are we in the VC investing cycle today?
In the sense?
I think around in that.
No, I think. See, we have also. I think we were here. We were probably at 200. If you look at it from as 100 as the base, we were at 200 in 21-22, 200 or 250 maybe. Now we are at 75 or 80. I think we'll get to 100. So we are not completely at where the normal is. We are definitely below the normal, but we'll get to normal, I think, fairly quickly. Now, I think if you look at the kind of deals that are happening now, I think in the last 2 months, markets have opened up a little bit from private.
And when do you see the deal making picking up? I think deals are happening all the way through. I don't see any
I think
early stage.
For the first 6 months, it was a little bit tough, but now I think at least we are seeing some, actually a lot of deals coming into the market. But they're taking time to close. So anybody who's looking at raising capital and budgeting 6 months should budget 12 months now. So because there is no hurry for anybody. There is no competitive pressure. There is no valuation uptake. There is no you're not growing like crazy in the next 6 months that it justifies higher valuation. And there are no FOMO kind of investors that are there. So essentially the challenge has always been that some of these fair weather investors, as I call it, they have disappeared, and those were the ones that were driving valuation because they didn't care about it.
And I think a lot of the HNIs, they've gone through one cycle. They have seen write-downs happen, companies disappear, and so they're like, okay, and wait and watch mode. Same with, like the fund. Dry powder is there, but, they want to watch and deploy at the end of the day. What do you think of, I think we've, retail investing in startups, right? I think it's good, I think, right? Broadly deepens
it's good, but they have to be. but they have to be aware of the risks that are there and make sure that, see, it's not, even the best venture funds give you 3 to 4x returns in India. I have not seen more than that, maybe 5x. So I think expecting, reading newspapers and expecting 10x, 15x is not sustainable and not possible. And there are going to be calls that are going to be taken by the manager that might look bad in hindsight, but they're doing it with the best of intentions. So those things I think we have to be aware of. Otherwise, it's going to be very, very challenging from a, see, if things go well, it is okay. But if things go bad, then it's going to be really, I mean, if you're not able to, see, some of the funds will not be able to return capital also. Absolutely. So what happens then? I mean, you cannot go and litigate because, I mean, you just have to write off and move on.
Right. No, and there is that whole ecosystem of bankers who are selling to people who don't understand the product or who don't understand the
product has to be
segment.
understood properly. You're absolutely right.
Super. I've got this ominous sign that says time up, so, and there as well. So thank you so much, Deepak. Pleasure talking to you. And
thank you so much for sharing the insights with us today, Deepak, Gowda, and Mano here. I would like to ask you to remain on stage for a few moments. Invite Chamit Choksky, CFA, Chairperson, Professional Learning Committee, CFA Society India, to present token of appreciation to Deepak, Gowda, and Mano here. For me, some of the takeaways from the session is one, the funding winter, which is actually something like a Chennai.